Hi, this is Mike Ward. I want to talk to you about Miller and Modigliani's theory of capital structure, which they came up with in 1958. Now, capital structure really means the mix of debt versus equity that we use to finance a company with. And what it does, it has an impact on what capital costs, or if you like, the weighted average cost of capital, WACC, as we tend to call it. Now, what Miller and Modigliani did was they started with what they called a world without taxes. Now, we can laugh at that because we all know that the only certainties in this life are tax and death. But it is true that there are times actually where companies do not pay tax. Sometimes that's because they live in a tax-free zone or in a very low tax part of the world, or sometimes even in higher taxed areas, they might have run up a big assessed loss over many years, and it'll take a long time before they actually start paying tax again. So it is possible. But what they said was, let's measure the cost of capital on the y-axis over here. So this will be what shareholders want, what the bank wants, and so on. And on the x-axis here, we're going to measure the amount of debt that we put into the company instead of equity. So they began their argument by saying, let's assume that we've got a point here, which we'll call here the cost of equity, and the U means unlevered. There's no debt in the company over here. So this is what shareholders want, assuming there is no debt in the company and assuming we're living in a world without taxes. Now, what they argued and showed, in fact, is that the minute you start to add debt into the company, the more debt you put in, the higher the cost of equity that shareholders want. And in fact, it's a straight line, goes up here in a linear way. And we can actually measure the slope of that line by this equation, which I'm showing you over here. Sometimes this is called the Hamada equation. What it really does is it shows us what is happening to the beta of a company. So when you're unlevered over here, you have an unlevered beta. But as you add leverage into the company, the beta increases. And so we can increase the unleveraged beta by 1 plus the debt to equity ratio times 1 minus the tax rate. In this case, the tax rate is 0, but there is still a change in the unleveraged beta over here because of the increase in gearing over here. 1 minus 0 is just going to make it 1. So the cost of equity increases. But we're not focusing on equity, remember. We're interested in what happens to WACC. And because we're putting in more debt over here, and debt is cheaper than equity, and I'm just showing it down here on this axis over here, it's interesting, but in fact, the weighted average cost of capital doesn't change. So in a world without taxes, there's no benefit at all to taking on more debt. And you can easily take on more equity, in fact. So something to remember. But that is a pretty unusual circumstance. So they moved on, and then they took their theory into a world with taxes. To begin with, everything looks the same. As you add more debt, so the beta increases. But what happens at the same time is we get a decrease in the cost of debt. It's now 1 minus the tax rate. So it's the cost of debt after tax. And what that does is it brings the weighted average cost of capital on a downward trek like this. And I'm probably exaggerating this here. It wouldn't be quite as steep as what I'm showing you here. But it doesn't keep on going down. At some point, what happens is it starts to go up again over here. And that's because there are bankruptcy costs being factored into the cost of capital. The creditors, the bank, starts to increase the interest rate because there's uncertainty and there are risks involved with too much gearing. And so the job of the financial management team is to try to locate this optimal range. And I've called it a range because really this curve is pretty flat around here. It doesn't really matter where you are as long as you're in a general area of this minimum over here. And in fact, you don't want to be too much on this side here. You'd rather be slightly less than the optimal range over here. they will try to keep the gearing of the company somewhere around there. From time to time, it's going to get a little bit too high, and then they'll do a rights issue, and that'll bring it back down here a bit. And so that's what it looks like. And at this point here, because we've got a low discount rate for the cash flows, a low WACC, the value of the company is also optimized. Now, this optimal range is going to be different for different types of companies. If you've got a company which has got very strong, safe cash flows, say a cigarette company or a pharmaceutical company, or maybe a healthcare company, something like that, then probably you're going to be able to increase the percentage of debt here, and this curve will actually go down further somewhere over here. Because of the safe cash flows, you can take on more debt. If you're dealing with a more risky company that's more naturally risky, say a resources company, a mine or an oil company or something like that, because of the inherent risk in the industry, you're going to find that this optimal range is over here. And then you don't get so much of a downward benefit from the debt. But nevertheless, because of the inherent risks, you don't want to put in too much debt. So this optimal range varies depending on what type of industry that you're in, but the principles are the same. Now, I want to show you all of this in Excel. And so I'm just going to load up a little model I've built over here. And what you can see here are two companies. I've just called them A and B. And at the moment, they're absolutely identical over here. You'll see we started off with operating profits, of 900 in each. And there's no debt, and we're paying a bit of tax over here. And you'll see the balance sheet down here is just equity, 4,000, let's say, euros of equity here, financing all the assets. And the cost of equity is the unlevered cost of equity at the moment, 15%, and it's the same for both companies. And if we are to capitalize the cash flows that are coming to the shareholders in this instance over here, we take this, in fact, this 630, and we divide it by 15%, and we get the value of the company here, just treating it as if it's a perpetuity. Now, what Miller and Modigliani showed was that this 900 that we're getting in terms of operating profit is really split between three different stakeholders. The shareholders are getting 630. There is no debt, so the bondholders are getting nothing. And the rest goes to the receiver of revenue. And this has to add up to 900 again. Now watch what happens as we start to increase the debt in Company B. So I'm going to just scale this up a bit. Let's put 1,000 euros worth of debt into Company B. Now I want you to notice that what we've done is actually we raised the debt, 1,000 euros, and we've repurchased some of the equity. So there's less equity now. And it's like we did a share buyback, if you like, because we're not changing the size of the company, the assets are the same, we're just changing the capital structure, the way we financed it. But now, because we've got debt, the operating cash flows are the same before interest and tax, but we have to pay interest this time. That means we pay less tax because the interest is tax deductible. And you'll see down here, this is the split now of the 900. The shareholders are getting less. The debt holders are getting something, and the receiver of revenue is also given up something. But although the shareholders are getting less, there are fewer shareholders. They've gone down by 25%. And so you can see here the earnings per share would have increased, and so they're getting higher earnings per share. That means the value of the company would have gone up. At least the share price would have gone up. Now, if we look at it from a WACC perspective down here, you can see what's happened. Our old WACC, ungeared, was 15%, the unlevered cost of equity. Now, notice the cost of equity has gone up. Why has it gone up? Well, because equity is more risky. The bank has to be paid first. And so the shareholders are factoring this in, and the beta has been re-leveraged. But the weighted average cost of capital, because now we've only got 3/4 of our capital from shareholders and 10% after tax, takes us down to a WACC of 13.9%. And you'll notice that the value of the company has actually gone up. Have a look at the interest cover down here. It's 9 times. That's pretty safe. But if we keep on increasing the leverage, I want you to keep your eye on this number over here, the value of the company, and you'll see that as we keep going up, it peaks and then starts to go down. And so I'm actually illustrating that here with these graphs I've got across on the side over here. And you'll notice that this is the WACC coming down over here as we put in more and more debt. But at some point, it starts to actually go up again because of the riskiness of the debt. And at that same point, the cost of equity is actually maximized, or the value of the company is maximized, in fact. And WACC is at its lowest, and the value of the company is at its highest. So that's what we're trying to achieve. Now, let me show you what's actually causing all of this, just to show you. If I scroll down here, you'll see I've put in a little table over here, which shows you what's happening to the cost of debt. As we put in more debt over here, you can see for a while, everything's fine. The bank are happy within some reasonable level of gearing. They don't worry about the cost of debt. We get the full advantage of it. But you can see here, as you start looking at what's happening to, say, the interest cover over here, at some point it drops to a certain level, and what happens is the rating companies downgrade the debt. And so instead of being AAA, it's now BBB. If we keep putting in more debt, it becomes CCC. What that does is it increases the cost of debt over here. And so we need to find that optimal point where the cost of debt is at its cheapest, and that is going to, in fact, maximize the value of the company. I hope that you found that useful.